Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about investing during this crazy market. So, we've got a lot of things to cover here. Normally, the way I run this is a 3+1. So, normally, I kind of run three topics that I think are interesting, and then I have like one topic, which is the book recommendation. But today, I'm not going to run with the book recommendation because I think that there's quite a lot of different things happening right here that I think is going to take up our time. So, I normally run this as about 20-minute kind of podcast and kind of go through and speak out my tiny little audience and kind of say things that I believe would help me when I was starting out. So it's also kind of helpful for me because the more I kind of have to look through and research what to talk about, I also kind of gives me a chance to learn as well. So it's kind of like a win-win for the two of us, really. Okay, so we're kind of going to kick this off and we're going to talk about the large caps, right? So are large caps going into a bear market? I think that this is something that's quite interesting right now because I invest predominantly in the mid cap to small cap space. You can kind of define, whatever you want to call a small cap. I don't know, like you can say small cap is less than, say, a billion. You can say that small cap is less than 10 billion. I have no idea. But anyway, this is like kind of a skew towards smaller businesses. Um, some of my businesses are not so small. They're kind of like upstart that's, God knows, now probably like 10 billion when it was like 25 or whatever just a few weeks ago. Anyway, so what's kind of interesting here is if you kind of been investing in kind of, let's say, tech names or whatever, kind of high growth names or whatever, since last February, you have seen your portfolio demolished consistently, unrelentingly, in a dispassionate manner. It's just been absolutely battered. However, the large caps had been quite immune to this. And, there's all kinds of theories about this. I've heard all kinds of theories. I've heard that it's because they make so much cash flow that people kind of believe that they're fairly valued. I've heard that it's basically ETFs buying them up, so the more expensive continue to be more expensive. I've heard that it's liquidity because large institutions can kind of trade in and out of them without really changing the share price very much, and you have to park cash anywhere, somewhere at some point. I mean, there's all kinds of reasons for this. But what we've seen in the last several weeks is that large caps have not been immune. And we've seen this particularly in the case of Netflix. So Netflix reported last night, and it's kind of interesting, right? So, I mean, Netflix is kind of a discussion in and of itself. But I'll just kind of highlight it just briefly, kind of for so long, Netflix's whole investment thesis was being driven by the subscriber addition number. So the more that Netflix was growing the subscriber addition number, people were willing to give that company a really um, wide kind of opportunity to kind of invest for growth. And I've kind of been on the two sides. I kind of in the past 12 months, I've been quite bullish Netflix. But there's always that kind of niggling concern that the business practically doesn't make any free cash flow. And everyone's like, oh, it doesn't matter. Well, who cares about free cash flow? They're investing for growth, investing for growth. Doesn't matter. Like, I don't get it. I don't get the big picture. Yeah, okay, fine. And, I like investing is so difficult. And it's always really easy in hindsight, right? Everyone in hindsight knows all the answers. But I'm kind of okay, fair enough, right? So as long as they're investing for growth, you can make the argument that they're taking market share away from, let's say, linear TV, and I get that, right? So the business is growing, they're investing for growth. You got about, let's say, close to 20% K coming out of them. Fine, business is growing, fine, robust, whatever, can it's a beneficiary of this kind of work from anywhere environment, blah blah. Okay, fine, get it. So for the past year, this business has been really kind of strong and going strong, even while the other streaming platforms are just getting absolutely demolished. I don't own Roku, but if you know Roku, it's like absolutely just got absolutely killed. And it's kind of interesting, right? So it's like on the one side of the equation is like those streaming platforms was too much competition, but at the other side of the equation, Netflix, it wasn't enough competition for them. They were just killing the market. Anyway, so fast forward, they put out the guidance for next quarter, Q1 2022, at 10% year-over-year growth rates. All of a sudden, people are like, oh my God, the subscriber number is really small. Oh my God, the business barely makes any free cash flow. Oh my God, does this actually matter? And Now the stock is down, let's say 20% after hours, and I'm kind of thinking to myself, okay, maybe after maybe I don't know, maybe free cash flow does matter. So I don't know. So because in the past they kind of at least they had the argument that they were investing for growth and they didn't make any free cash flow, but there was that kind of side argument. Anyway, as it transpires, it's really interesting right now because the first companies to report is like Netflix, and then kind of next week is going to be all the large caps coming out. You got your Amazons and whatever. You got Microsoft coming out on Tuesday, and so it's going to be really interesting how the market is going to take this up because coming out of Q3 21, I'd said as we go into this, growth names have been they've been taking a hit, but they've been kind of the valuations haven't meaningfully compressed. This was starting, let's say, end of October, start week of November. I've been saying, and the first one of the kind of, let's say, the high growth names to report was Snap, and Snap got killed, and then DocuSign got killed, and then like everything else started getting killed. It was just like it was just getting killed. And since that period, like if you've been investing in, let's say, mid and small caps, you've already been in a bear market for a while. And as I said, large caps, they're going to report next week. And if large caps don't live up to people's expectations, which I think is going to be difficult because I haven't been investing in large caps because I believe, and so far I've been so wrong this past year. I have believed for the past year that large caps were stretched, and I felt that small and mid caps were more compelling investments. But so far, I've been proven wrong for the past year, so it's really important going into the next few weeks how this is going to work out, and you're going to kind of see the follow up to that next week when I report on Friday, when I can do this podcast on Friday. But it's going to be really interesting if the large caps come out and they don't live up to investor expectations because there's such a large, like approximately what is it, top five companies make up approximately 25% of the index. So it's going to really bring down a lot of the ETFs. And if the ETFs start selling, and then you're going to have the algos selling, and then we're going to be in really kind of a bit of a fun environment. So it's going to be quite interesting to see. And the next 2 weeks are going to really define a lot about this market. So it's very good, very exciting. I mean, it's difficult to not be excited. Okay, so I want to move on. The other thing that I want to talk about is this, right? So it's quite an interesting thing, right? So I'm gonna go through because everyone is like wants to invest in the leaders, right? Everyone wants to invest in the leaders. And what is it? Growth at any price, growth at reasonable price, investing in growth companies at all costs, investing in the leaders. Leaders have a large moat, blah 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 blah. So I'm just gonna add a bit of perspective, right? So going back to 1980, the top three companies by market cap were IBM, ExxonMobil, and AT&T. Okay, so IBM is kind of punching a little bit. Probably the stock hasn't gone anywhere in like the last 15 years, but that's all American. Those are the three companies. Go for the decade, and you got NTT, never heard that. Industrial Bank of Japan, never heard that. Fuji Bank, yeah, okay. Also never heard that. So all Japanese names. So 1980, all American. 1990, all Japanese, right? Then we go into the 2000. You got General Electric. Everyone knows what happened to General Electric. You got ExxonMobil. Wow, and you got Microsoft, all American. So they changed. This is my point. So no business really lasts forever. Things change, right? Now, 2010, you got PetroChina, ExxonMobil, and Microsoft. One Chinese and two American. So you got Exxon and Microsoft were in the 2000 group, and they're also in the 2010 group. So that's really, really interesting. Then you go to 2020. In 2020, you have Apple, Saudi, Aramco, and Microsoft. So Microsoft is the only company that has spanned 3 decades as a leading company. So you think of all the companies on the planet Earth, right? Think of every company. Like I'm not just talking about, let's say, in the S&P. I'm looking, or even let's say the Russell 2000. I think there's a lot of companies out there in and outside of the US. And of all those, only Microsoft has managed to stay around as a leading company for 30 years. So the odds when you buy a really high multiple stock with high expectations, such as for the I believe like something like Apple, there's a lot of expectations that it's going to be a leading company for the next 10 years. Now, it's going to be difficult because historically this hasn't happened. It's happened once with Microsoft, but you can't really build a whole thesis on saying that it's likely to continue because every time, every decade, it's like this time it's different. These are the leading companies. They're going to be never going to be displaced. They're always going to have a moat, this and that, and it's kind of like history is quite cruel in that way that it just kind of, it doesn't care. It just, sets its own path. So that's something that I think is quite interesting to think about when it comes to when people are paying really high valuations and going into the important earnings season right now. Okay. Um, so the one question that I've heard a lot in the past several days, people reaching out to me is like, is this a good time to buy? So just gonna try and answer this by asking a question. So when it comes to investing, what are you actually trying to do? What you're trying to do is you're trying to buy something for less than it's worth. Now, the best way to think about it is you're taking a portion of the company and you're holding a portion of the company. Okay? So you're investing in the company's prospects, and by aligning yourself with the company, you're going to benefit from the company's growth in intrinsic value. So it's really doesn't matter like if you're a growth investor or value investor because you're participating in the growth in intrinsic value of the company. So the longer the company continues to grow as a business and produce stronger owner earnings or free cash flow, the longer you are invested alongside that, the more you're going to benefit. Yes, the share price does oscillate, over time, higher and above intrinsic value, but for all intents and purposes, if you stay around, you're going to be able to benefit from that. Now, there's no doubt in my mind that the risk reward right now is really favorable. Many companies have been absolutely battered. This does not mean that in the next 3 months they cannot be battered further. There can be a truly just like a huge capitulation of investors and just kind of throw everything out and just give up. And in that event, things can get really, really dark and bitter. But if you look from this point right now over the next 2-3 years, the likelihood is that the businesses are going to be still around, still growing. There's a question mark of how much they'll be growing, but the businesses will be growing. And relative to the price that you pay right now, you're going to benefit from that over the next 2-3 years. But again, this doesn't mean you kind of go in and dump all your money right now because things can get really crazy. And you need to make sure that you don't get overwhelmed when you invest. Because when you invest, a lot of it is psychological, and it's very, very difficult as an investor to buy a portion of the company and to stay with the company for a long period of time. People get bored, people think it's dead money, people get nervous, is it going to fall further? Man, there's always a reason to sell. And those reasons to sell get so invoked in a person when the share price is falling. So if you kind of go in and you buy now, oh, this business is falling, let's say 50%. It's like this is a really good time to buy. Or there's an Einhorn quote that I put out this week, which was the Einhorn quote is like what you call a business that is down 90%. There was a business that it was down 80%, and then it went down a further 50%. So just because something is down 80% doesn't mean that it cannot continue to sell off, right? But it's just about trying to figure out, are you going to be able to buy into this business and stay with it for a reasonable period of time? Let me jump to the next slide. So there's a few things that I kind of wanted to unpack here. So what you need to do is you should try to figure out the strategy that works for you. So I'm talking about the strategy that works for me, but you shouldn't invest in a business because it feels good. There's a lot of buzz around the company. People are really talking about it a lot. Now, the people are talking about it a lot, and that buzz around the business quickly fades, and it can fade really, really quickly. So don't buy into a business because there's a lot of buzz. Don't buy into the business because it feels good, right? And this is kind of the thing with the with the Peter Lynch kind of investing strategy. It's kind of like, oh, I kind of know the product and I like it and this and that, and I'm going to invest in it, right? And so the example that I kind of give is like, let's think about Zoom. So Zoom is a business that a lot of people have used, and you kind of understand how it works and etc. And you kind of buy the shares, and then the shares kind of collapse by like 60, 70%. And you're like, oh my God, yeah, this is probably not a good time, and I'm going to dump the shares. And what happens is that when you kind of dump the shares, it's like, I'm never going to invest in that business again. And from this point, over the next 2, 3 years, the likelihood that you're going to make a reasonable return, for example, on a company like that, is pretty strong. But you have to stay with that company. And a lot of people don't have the staying power. So when it comes to investing, it's a lot more about conviction in your process than it is about the process itself. So it doesn't matter how you come around. So you may have the Peter Lynch strategy, you may have just a quantitative look and you say, okay, the business is growing X amount and the margins are this wide. And I believe that it could make about, I don't know, 200-300% growth in earnings over the next 2, 3 years. I'm going to put this multiple in the stock. Doesn't matter. So it's much more about you having conviction to hold on to your investment. So figure out how to get conviction and keep working to get conviction. One of the ways that I kind of do this to get conviction is I spend a bit of time reading around the conference calls. I kind of go listen to the conference call. You can just listen to it at double speed and you can just listen to it and you can just kind of see what's the narrative that the company is putting out, trying to spend a little time listening to that narrative. Now, it's very, very thin layer between you listening and not getting entrenched. So you need to listen with an open mind because a lot of times you kind of commit yourself to listen to, I don't know, like the Zoom analyst calls, and you kind of spend a lot of time listening to it. You kind of build a lot of conviction, but you have to back that up with the numbers. You have to look through and kind of think, okay, do the numbers make sense? Because that's ultimately how you're going to get your reward, is picking out the right kind of valuation metric. But ultimately, you have to read around your businesses to kind of get a conviction. So some people like to kind of day trade, and some people like to have a like 5-year horizon or 10-year horizon. It doesn't matter how you invest. All that matters is to have a lot of conviction into your process, because when the markets go slightly sour, that's not the time to start building and thinking about your conviction. You have to know very much implicitly and explicitly your investment strategy. As I talked about in last week's episode, what you're trying to do in this whole investment process is survive. You need your portfolio to compound over time. So it doesn't matter too much whether it comes all from one stock or it comes all from little bits of, different little stocks, doesn't matter. It doesn't matter if your process is totally different from mine. There's some kind of fundamentals here that overlap. You need to have a conviction because you need to be an independent thinker of why you own XYZ business. And you can like change your mind as well. That's absolutely fine. But you need to have a process whereby you kind of restrict yourself. So the way that I like to do it is that when I go to buy a business, I think to myself, okay, if this goes really, really sour right now, I'm going to stay with this business for a year. I call this the grip of death. This means that basically, come anything, whatever comes, I'm going to hold on to that business for a year, because that stops me kind of having a bit of a, getting a bit fidgety. So I have the grip of death and I hold on to that business really, really tightly. And I'm like that, having that kind of line of thinking before I buy the business really kind of helps me out, because I know that I'm going to be stuck with that business for approximately a year. So I need to know before I buy it that I'm going to have what it takes to stick it out. So I need to have a lot of conviction behind those numbers. Another thing that helps me, and you might not have this chance, but what's something that helps me personally is that I have the ability to follow these businesses for quite a period of time. So I write about them. Sometimes I even, if I like the business, I'll put out a bearish comment on it just to kind of see what people come back with, just so I like to kind of read through those comments and see what people say, because I have the ability to follow the company for a period of time and I get to know the business quite well. In fact, some of my best investment returns have been on businesses that have been really, really bearish in the past. And I say, okay, I've been missing this, and I change my outlook and I'm like, okay, actually, I was wrong and this is the right way. So an example with this was Square. Square was something that I was really, really bearish. I was like, oh my God, this is business sucks. Oh my God, this business sucks. And early back in 2020, I was like, okay, this Cash App is actually doing really, really well. And I was totally wrong in this, and they're actually doing really terrifically well. And, I was quite lucky, and it kind of worked out really well that my timing was right. It's often that the timing is not right, but, I was quite lucky. But I have other investments like that as well. So, for example, I was quite bearish for a long time on the trade desk, and then approximately about like 2020 as well. I kind of went long the trade desk, and I was like, okay, this makes a lot of sense, and I kind of went long, and I kind of did really well there. Oh, Nvidia was another example, and yeah, so sometimes it kind of pays to kind of be a bit slower at kind of building your position and kind of coming around to thinking about whether you should invest or not. Yeah, so I mean, I hope you found this kind of video useful. Let me know in the comments below if there's something that you'd like me to address next week. And as always, I'm going to ask you, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor. I give you high quality, actionable investment insights. And lastly, please drop me a like, because that motivates me to keep going every Friday, 9 a.m. Eastern Time. Thanks, guys. Bye bye.